Hi there, I'm Edward Kalstian, founder of EKH Capital, where we look for market-beating stocks for the long run. This video is part of my 5-part series explaining the 5 key factors I use when analyzing companies. Today we're finishing with key factor 5, a company's moat. A moat is a company's competitive advantage, what protects its profits from competitors in the long run. Charlie Munger added that the best businesses are those that can fend off competition for decades. Without a moat, even high returns and growth can get competed away. Think of it like owning a castle. Without a moat, invaders can easily storm the gates. With a wide, deep moat, your castle remains protected, and so does your wealth. In investing, the moat is what lets companies defend margins and returns against fierce competition. There are several types of moats I look for. First up, cost advantages, scale or efficiency that competitors can't easily replicate. Next up, switching costs, products or services that are hard or costly to replace. The third, network effects, businesses that get stronger as more people use them. Fourth is intangible assets, strong brands, patents, or proprietary technology. And finally, regulatory or structural barriers, legal protections or high barriers to entry. I also ask a critical question: how durable is this moat? A patent might expire in 10 years. A brand could erode with poor management, but scale and switching costs can last decades. The durability of a moat matters just as much as the existence of one. Let's take Microsoft as an example. Microsoft's moat is built on several layers of competitive advantage. First up, its software ecosystem. Windows, Office, and now Teams is deeply entrenched in businesses worldwide. Next up, switching costs, which are extremely high. Once a company standardizes on Microsoft tools, moving away risks massive disruption and retraining costs. And finally, its cloud platform Azure benefits from scale and integration with existing enterprise systems, giving Microsoft a durable edge in one of the fastest growing markets. This combination of brand strength, switching costs, and scale creates a moat that has lasted decades. It's why Microsoft can maintain strong margins, defend market share, and keep compounding year after year. Identifying moats often requires connecting many qualitative and quantitative dots. I use Fiscal to help me dig deeper by combining financial performance with industry analysis. If you'd like to do the same with your research, check out Fiscal with my affiliate link below. You'll get 15% off at no extra cost to you. At EKH Capital, I look for companies that don't just grow, they protect their ability to grow. As Peter Lynch put it, the best stock to buy is the one you already own, if the story hasn't changed. And the story stays intact when the moat stays intact. This is why I often hold companies for years and preferably even decades, as long as the moat remains strong. A business with high returns, strong growth, and a durable moat becomes a compounding machine. The day the moat erodes, the investment case changes. And that's when I may consider selling. Moats matter because they defend profits from competition, enable reinvestment at high returns, and extend the compounding runway for decades. If you're a long-term investor, identifying moats is non-negotiable. They are the ultimate insurance policy that the performance you see today will still be around 10 or 20 years from now. Investors who ignore moats risk owning businesses that can't sustain their performance. That's key factor 5 and the final piece of my investing framework. If you want to see all 5 key factors in action, check out my other videos in this series where we break them down step by step. If you found this helpful, please hit like and subscribe, and let me know in the comments what's the strongest moat you've ever seen in a stock. Thanks for watching, and I'll see you in the next one.